pretty clear when you've got something that customers are asking, not you're sort of pushing it onto them. And that happens in stages and different levels of scale. You think you have it at a sort of one stage, and then you reach a certain level of scale, and you realize, okay, to maintain the growth that we've had, we need to introduce something new, and iterate and iterate.
Welcome to the Product Market Fit Show, brought to you by Mistral, a seed stage firm based in Canada. I'm Pablo. I'm a founder turned VC. My goal is to help early stage founders like you find product market fit. Welcome to the Product Market Fit Show. Today we have Mike, the founder of TopHat, a net tech startup based in Toronto that has over 500 employees and has raised over $200 million. And now the founder of Silagadze Financial, a quantitative DeFi fund. Mike, it's a pleasure to have you on the show.
Great to be here. Thanks.
And so today we're doing something a little bit different. I think often the topics, the episodes here are really aimed at first-time founders in those really early stages. We're still talking about the early stages, but the topic of today's episode is how to start a second startup. And it's probably going to be most applicable to all the repeat founders out there that have done something before, whether it was a huge success or not, have obviously learned a ton from the first go at it. And now we're thinking of starting a new one or have already started a new one, and getting, Mike's perspective on what that's been like, right? What's been easier, what's been harder, and so on. So with that said, Mike, maybe it'd be good to start at the beginning and just go through relatively quickly. I know it was a long journey, but relatively quickly, like the story of TopHat, how you started it, and just how kind of things went, and we can go from there.
Yeah, happy to do that. So I'll give you kind of my journey and talk a little bit as well how it weaves into the the new company, Silagadze Finance, that I've started. So I started TopHat more or less right out of undergrad when I graduated university, and having just graduated, being a recent student, the experience of being in university was fresh in my mind, and so it was kind of natural to focus on education technology. I think a lot of one of the mistakes, frankly, that entrepreneurs tend to make is they'll start a company in a completely kind of random domain that they don't have a lot of experience or they don't have firsthand experience with the particular problem that they're solving. And we did a little bit of that when we first started TopHat, but fairly quickly we were able to kind of pivot and focus much more on a domain that I was familiar with, which was education technology. And the particular problem that we wanted to solve was the kind of notion of student engagement. In other words, our experience in university was that the higher education experience had not changed all that much over a period of really hundreds of years. But at the same time, the students coming into university had changed pretty dramatically. In other words, their expectation and their experience in learning things outside of the traditional educational context had changed pretty substantially. And so there was this disconnect, and students were getting disengaged and not really seeing as much value for their dollar in their higher education experience. And so our vision was to create a platform where students could engage, to have a more engaging learning experience, both with their professors in class as well as with the content that they're consuming. So replacing traditional textbooks, for example, with digital interactive learning materials, and using tools and technology in class to create a more engaging learning experience. The whole vision around that kind of came together over a period of time, but that was the general kind of theme of it. It was a very long and extensive kind of journey. I ran TopHat for about 11 years from start to finish until I left to start this new thing, and experienced all the same challenges that probably anybody that starts a tech company experiences, from initial fundraising in a very difficult market environment, which was the time of the last crash, the 2008 2009 crash. So that was extremely challenging, and raising money, and not only that, but raising money for product in higher education was particularly tricky because education generally is known to be a very difficult, market. During all of that, all throughout that process, I'd been dabbling in and kind of experimenting with, playing around with crypto, and just following that space, pretty closely. And in 2020, what got me excited and what really changed in the crypto space is it went from a market that was entirely speculative to, with the birth of DeFi, decentralized finance, to a market where actual software was now getting built and real productive assets were being put on chain rather than just people kind of gambling and speculating on tokens. And that got me really excited and gave me a lot of conviction that over time, a significant amount of value that's being transacted in the world was going to replatform onto crypto rails, onto DeFi, that was the motivation for starting this new venture that I'm happy to tell you more about.
Awesome. So that's a good synopsis. Before moving on, like maybe a quick question with a long answer on your first startup. Like, what are some of the main turning points? Like when you think about that 11-year history, there were struggles and then there were kind of up into the right moments. Was it kind of a big first round? Was it a big customer that you signed at some point where things kind of shifted from, the classic first time founder struggling to, really getting some of that success?
Yeah, there were many. I'll talk about the first one that kind of comes to mind, and it was one of the very first ones. I think there's a lesson there for entrepreneurs. There's a number of challenges you have to solve as a first-time founder. One is, picking a domain, a product that you think makes sense and that it solves the user's problem in a way that's compelling. And people often iterate on the product and the go-to-market sort of mechanics, but oftentimes, or at least in our case, one of the things that we had to pivot was not so much the product or even the go-to-market, but it was rather a different customer within the same go-to-market. So it'll be a bit more concrete. Initially, when we started our company, we had this product that was aimed at student engagement in higher education, and we naturally felt that, the logical thing to do is to go to universities where the product was aimed and talk to the university administration and try to get them to buy this thing for their school. And as we did that, fairly quickly, it became clear that, although the universities sort of ostensibly are there, at least partially to educate students, or at least that's what, most people kind of look at it, the incentive structures within universities are set up such that the amount of resources they're willing to expend on actual teaching technology and investing in student engagement, not super high. It's just that most of their revenue, most of their funding comes not from being really good at those types of things. It comes from research grants. And so we very quickly realized that trying to sell to the institution, basically at the enterprise level, was going to be a dead end, especially in the beginning, because it would, you're talking 12 to 18 month sales cycles. You're talking very, very budget constrained. And so the result is, 12 to 18 months, your company's dead. You have there isn't a clear path to success there. And so we had this kind of crazy idea at the time. At the time, it was sort of a crazy idea, selling our software product the same way the traditional sort of print textbooks were being sold. In other words, same product, but instead of selling it to the institution, we go to individual decision makers, professors, and get them to adopt the technology in their class in the same way they would adopt a print textbook. But instead of students going out and buying the print textbooks, they would buy a subscription to our software, and that would be used for some of the content and in-class engagement. We were one of the first companies to do, maybe even the first. We were very early in coming up with that kind of weird model. Over the years, other folks saw our success, used the same business model, and it became kind of standardized to where lots of companies now are pursuing the same kind of approach. But at the time, it was a pretty radical departure, and frankly, we weren't sure it was going to work. We talked to our investors, prospective investors, and said, "Hey, look, we're going to do this," and we're met with a lot of skepticism, frankly, because it was well, this is weird. You don't sell software that way. It's almost like, imagine you're trying to sell software to a corporation for, I don't know, accounting, and instead of going to the CEO or the accounting department, you go to the individual accountants and say, hey, you should use this software. I mean, it's not just about the product market fit. It's also about finding the right customer and the right channel to sell into. And I've seen a lot of companies sort of fall down on that aspect of it, especially in education. That's oftentimes the hardest thing to figure out in education technology.
I think it makes complete sense. Another way to summarize it is to think through, you've got a product that offers a specific, set of values or value prop. Who cares about that, right? Like who really, like in your case, you're ultimately helping, students learn better, or, in a more, in a less antiquated way, let's say, who actually in the organization really cares most about that. And I think if you think about that, you
make a decision,
and who has the power to actually act on it, right? So it's kind of this, this kind of thing, two things crossing together, and that's where the professors come in. And there's professors that care about teaching, there's some that don't, but the ones that do, really do care about student outcomes. And so something that's going to make that better, is something that's going to speak to them more than maybe other people in the organization. So that makes a lot of sense. So that's helpful. So maybe moving forward, like as you start, one of the first questions I have is, and because I've seen a lot, it's actually relatively common, I think, for founders to get their startup to a certain level and then transition out, right? It's actually the exception of founders that like to and are capable of staying, as CEO all the way till post IPO and so on. So what was that transition process like? Like as you decide, 2020 comes around, you're deciding crypto's interesting enough that you may want to jump into it. Where are you at? Where's TopHat at that point? Where are you within it? And then how do you play that?
Yeah, that's a great question, and you're right. I mean, an 11-year journey is a long journey. I mean, it was. There's a lot of things that I enjoyed about the education space, and a lot of things that are extremely challenging. Frankly, probably one of the hardest markets to operate in. 11 years was a long time. We scaled the business to a pretty high degree, raised a ton of capital. A lot of things came together to start thinking. All right, I think this is natural. Any entrepreneur that you talk to that's been at it for that length of time, almost all of them, at some point start thinking like, all right, maybe it makes sense to transition out and focus on something new and exciting. For us, as I mentioned, there are a couple of things that came together. I'll talk about a few of the things that I can talk about, which is. We had an acquisition offer come in that was pretty compelling, and that prompted kind of a conversation around other options other than just selling the business to a public acquirer. I think you can talk about this. One of our investors stepped up and said, well, why don't we, rather than selling to an acquirer at a certain valuation, why don't we actually take a majority share of the business, and then you can have an exit, and the business can continue on. And I viewed that as a good opportunity because it on the one hand there's sort of a finality to it. We're like, okay, cool. My part of this marathon is done. This relay race is done. But in addition, I would get to keep some of my equity and ride the business as it continues to scale and grow. So that felt like a good option. I mean, in comparison to getting acquired, where usually there's a lockup and you're kind of required to stay with the acquirer for 2 or 3 years. This felt like a better option. And at the same time, as I mentioned, I'd been spending some time dabbling in the crypto space, and with the emergence of DeFi, I got pretty excited about that. And I felt like, I strongly feel this is going to be one of the most significant transformations in really the history of mankind. I mean, this is if we truly get to the ultimate, this kind of ultimate end state, where significant or all value is transacted on the blockchain, and there truly is a stateless currency that emerges. I think that'll be one of the most important changes in the history of humanity. And so I felt like I have to, I got to work on this. Everything else just didn't seem nearly as exciting or as important. And so those combination of things were what ultimately, led to to the transition. And it was a long process. I mean, it took well over a year to get everything kind of set up and transition out. Going through the process of finding kind of the next CEO and recruiting them and getting them into the business. I mean, that was a pretty lengthy process as well. I'll talk a little bit more about the transition. One of the things I don't know that I realistically would have done it any differently, but I didn't really take a break. In fact, I kind of overlapped the two businesses. And I also had a son, my first son. My wife and I had right as the new startup launched, literally 2 days before he was born. So that was kind of a crazy thing to do. I don't know. I kind of, in retrospect, wish I took a couple of months off, but
well, I'm curious maybe on that, because that's one of my next questions is, how did you, like, if I think about the beginning of TopHat, there was probably a lot of kind of, the happy accident sort of thing. Like you stumble upon, this idea and you start digging and you end up with what you ended up. Was this a bit more methodical? Like you saw the market and then how did you decide? I get, okay, you want to work on crypto, you want to work on DeFi, but how did you come up with the actual idea? Was that done a little bit more by design this time around?
So maybe I'll give a little context about what we're actually doing, and then
sure.
Build on that. I'll give a 30-second summary of like the context of crypto. So, in the beginning in 2009, Bitcoin came out, and Bitcoin was the innovative aspect of the protocol was this consensus mechanism that allowed, in a decentralized way, all the different parties in the world that transact on Bitcoin to come to an agreement on every transaction and solve a number of problems that are associated with a decentralized currency. But it was very simple, deliberately so, in that, with Bitcoin, all you can do is send your Bitcoin from point A to point B, and that's all that's possible. And then around 2016, I would say the logical extension of cryptocurrency platform emerged called Ethereum, that created a smart contracts platform, which is, rather than just reaching consensus on transactions of sending Bitcoin from point A to B, the consensus would be reached around the outcome execution of computer programs. So that which are called smart contracts, and that generalized kind of computing platform, this decentralized computing platform that can control money ultimately, was a pretty remarkable innovation, and opened the door to creating a very interesting array of sophisticated kind of financial rails, like lending and borrowing contracts, decentralized exchanges, derivatives, and many of the financial instruments and tools that we use in the traditional finance system, re-implemented on the blockchain in this sort of decentralized, uncensorable, sort of permissionless way. And that was very exciting. It took initially what it was used for, kind of inevitably, was just gambling. I mean, for all intents and purposes. And even today, I would say, pick a number, 95% of the activity that happens in crypto is various forms of gambling. And that is not super interesting to me. I mean, I think that's inevitable. And, if you think about even the stock market, what percentage of it is value driven versus what percentage of it is just gambling? I think it's hard to put a line on that, but especially with the sort of the monetary policy that we've had over the last few decades, I would say a significant portion of it was gambling, right? What was happening with meme stocks, GameStop and AMC and whatever, Bed Bath and Beyond now. Like, that's not really like value driven. That really is. I mean, it's just gambling. It's just excess liquidity in the market kind of finding a place to go. So the exciting thing to me are these financial rails, and ultimately connecting those to real world assets, actually bringing out real assets onto the blockchain, and then bringing about this ultimate kind of end state of a stateless currency, or a decentralized currency. And so the way that we chose to get started, building in this space, was to start a fund. There's a number of purposes for this fund. One is there was just opportunity. There was not a lot of expertise out there on how to allocate and invest in the in the crypto space in a rational, sort of safe way. There's a tremendous amount of gambling and speculation, and lots of funds organized around that. But there were hardly any funds that were specifically focused on creating exposure to the activity that's happening in crypto without having to speculate on particular assets. And so that's basically that's what our fund does. Is we have a market neutral hedge fund that uses quantitative strategies, focuses on things like arbitrage and market making to generate a yield and return on dollars, without taking exposure to the volatility of the crypto assets. And we've been doing well, while the markets, both TradFi and crypto, are down, depending on what sector, from 20 to 80 or 90%. We're up, I think, around 11% over the last year. So we've done a lot better than the rest of the market, a lot better than most crypto funds, because obviously crypto funds that took out leverage or were speculative, many of those funds kind of imploded. So we feel really good about that. But there's a second purpose to this fund, which is to finance the development of tooling and technology that's going to be focused on the crypto space. And we've got a couple of things that are in the works for that. And that is the reason that's sort of relevant and interesting. Is my hope is to build this the second startup in a different way and finance it using sort of alternate means, not the traditional kind of venture capital model. Now, there's a lot to like about the venture capital model that many tech companies are used to finance. It's really kind of amazing, actually. There's a huge amount of value creation that happens out of that model, but there's also there's pros and cons. And so the idea of this sort of hedge fund that generates boring, predictable returns, and then using the income from that to finance technology development that's focused on building these crypto rails. That's the sort of the premise of what Gadze Finance is about.
Got it. And so, I mean, the obvious question, you went through TopHat with VC financing, and it worked out quite well. What were some of the cons that made you decide to go a different way this time?
Yeah, and again, I want to, before I answer, I do want to stress, I think venture capital is really, really good. I think if you look at the percentage of GDP that's driven by companies that were venture finance, it's some crazy number. I mean, I think it's over 30% or something like that, which is amazing because venture capital is a tiny slice of the financing. I mean, I don't even know if it's 1%. So you've got this tiny little slice of the finance sector that's producing these huge outsized returns in a very real sense. It's producing a lot of value that's benefiting people. If you look at the top 10 companies in the S&P 500, a lot of them are venture funded businesses. So it's really good, and it works in a lot of ways. It's an amazing way to finance high risk activities. Okay, with that being said, first of all, venture is not right for many businesses. Venture is it makes a lot of sense for things that are intended to grow very quickly and capture a market or an opportunity in kind of usually technologically enabled way, and can scale to a very, very large size. Venture doesn't make sense if you have a business that's going to scale to $10 million. It really venture returns are driven by businesses that scale to hundreds of millions or billions of dollars, and that's where all of the returns, for all intents and purposes, come from. So for one thing, there's just a category and that's a very small percentage of businesses fall into that category. The 99% of businesses don't. It would be wrong, frankly, incorrect to try and force them to grow 2% a year and try to scale to $10 billion. You end up breaking a lot of businesses, and that's what a lot of founders end up doing. Is they're sort of LARPing at startups. They come up with an idea, they try to fit that company or idea into the mold of venture capital, even when it's not really appropriate. Given the financing environment, that's been, I guess, attractive to do that. So that's one aspect of it. The other aspect of it, I would say, and it's related, is venture tends to push a kind of short-term thinking. Oftentimes there's a conflict in the business between doing what the right thing for the business would be if you were to run it for the next 20 years versus doing the thing that's going to allow you to hit the next milestone. And the next milestone typically is the next fundraise, the next milestone, in the traditional kind of startup journey. And so you see a lot of businesses, doubling down on processes or customers or markets or go-to-market methods, the right thing to do is to take a step back and say, look, we need to take 12 to 18 months to retool and really, rebuild this thing to get to the next stage of growth. But at the same time, you think, okay, well, but we need to get to the next fundraising in 6 months or 12 months. And so that conflict and that kind of short-term thinking, it would be good to avoid that. I don't know. I guess that's kind of how I felt. I wanted to do something where I could focus on something where I just think about what is the right thing to do if I'm going to run it for the next 20 years, not what's the right thing to do to hit some arbitrary milestone, 6 months from now. So that's one of the reasons that I started thinking, okay, well, is there some other way to finance, technology and business creation? And so this new thing is an experiment in that.
Makes sense. And so, one of the questions as we start comparing, like your second startup, your first one, what were some of the easier and maybe let's start with that. Like, what were some of the easier things? Let's talk about fundraising, for example. How did that compare? TopHat fundraising versus Gadze fundraising.
Yeah, that's a great question. And there's so many things are different. One, the market is different. When we were fundraising for TopHat in the early days, there was no startup ecosystem in Canada, in Toronto, where we started. Really, there was none. There were no VCs. There were a handful of angel investors. And I say literally a handful. We raised money from kind of random people, from random consultants and executives and lawyers, just random people that could write a 25 or 50K check, in exchange for 20 or 30% of the business. Like that was the environment that we were in. So it took us, I think, 6 months to raise our first 200 or 300K round of financing, just by the nature of that. It was a recession. People didn't have a lot of capital to allocate. There weren't investors. So very, very different and very difficult. And, and we didn't have a track record. The second time around was completely different because, once you have a success and the fundraising environment is a lot stronger, you can get a conversation very easily. And generally there's a level of trust that okay, look, this is a person that knows how to execute, knows how to build a thing. There's a very high likelihood that that it's going to be successful. So it was much easier. We just approached Boris, who was one of our investors from TopHat, talked to him about the idea of what we're building, and it was a very quick and easy process to raise the capital. And it wasn't even really about the capital. It was mostly about bringing on a number of smart people kind of around the table that we could use to help us along the way.
Makes sense. And because here's one thing, as you go in, because I've had this conversation with many founders, and I felt to myself, as you go through a startup, especially your first one, you make a lot of mistakes, you learn a lot of lessons, and you have this kind of ongoing thought. You're like, wow, when I do this again, it's going to be so much easier. I'm not going to do this. I'm not going to do that. I'm going to fix some of the things. That's true. Like fundraising is an obvious one. Not only do you just get much better at doing it, you also just build this track record. And so all these things are in your advantage, and it actually ends up being way easier. What were some of the, are there any things you think about that were surprisingly not that much easier when you actually got through it and did it the second time around?
Yeah, absolutely. So the interesting thing is, and exactly as you're saying, I thought that as well. Yeah, the interesting thing is that I realized that the mechanics of starting the startup, the really basic stuff that's common to all startups is not at all what creates value. That's not what leads to the success of the business. Even fundraising, that's not what creates value. It's not about yes, you need to be able to fundraise to keep the business going, but that doesn't create value. What creates value is a product and customers and solving a real need. And that is just as hard. Well, it's almost as hard the second time around as the first time, because those are the real problems. Yes, we could short circuit the fundraising process a little bit, and a lot better at hiring, this time around, and just a lot of those things are easier. But the hardest part is actually coming up with a product that makes sense, and continuing to make decisions that lead that product and strategy in the right direction. Like that's the hard part, and that doesn't. I don't know that it's been easier. I mean, it's there. We've had lots of challenges along the way already. Less than a year in, so I don't know if that gets any easier.
I think it's a really good point, and there's many ways to look at that, but I agree. I think getting set up with a lawyer, an accountant, getting funded, setting up your corporation, and then all the things that you just need to do and you kind of get stuck on as the first time around, like, oh wow, to do this I need that, whatever it is, getting insurance, like all these things. Yeah, your second time you kind of snap your finger and it's more or less done. Not that easy, but basically. And yet the core thing that a startup does is it creates true meaningful value, and that part is just really hard. And so I think when you are a first time founder, if you have something that's really creating value, you do have to understand, like, it's not that easy to come up with another idea that's going to do that, right? Like, so you kind of going all in and getting the most out of this one is pretty important. I mean, a lot of people do come up with a second one, like in your case, but it's not like it doesn't matter because I'll do this. Maybe I'll just do a small exit and then I'll come up with something much better. Maybe, maybe not. It's not that simple.
Yeah, and it's the cliche is it's not about the idea, right? It's about your ability to iterate and develop it into something that is correct, that sort of matches the reality, rather than getting stuck on whatever idea you haven't come up with the first time around.
Perfect. So maybe kind of starting to wrap up, like, where's Gadze at today? Like, you have the main fund, kind of how's that going? And then we talked a little bit about that, but what about the other products that you're starting to build out?
Yeah, no, it's we've already had a number of, I guess you could sort of call them pivots. We built up a platform, or a tech platform is the wrong word for it. A trading system, trading and monitoring system in the first 6 to 8 months of the system of the company. Realized that we built it on the wrong technology foundation, and over the last couple of months we rebuilt it from the ground up, and the new thing just started trading a week ago. It seems to be going well. So I mean, that's an example where, like, you think you can like you're not going to nail every decision just because you're doing it for the second time.
The last question, which we always like to end on, and maybe thinking back to the TopHat days, because Gadze is still like relatively early along on this front. But for TopHat, like, when did you feel like you had true product market fit?
I don't know that we ever felt like, oh yeah, no, we're done, like this is it, because we just kept having to reinvent the business sort of over and over again, at different stages of growth. At any given stage, I guess, I mean, there's so many things to say about it. Like, the most compressed kind of answer is, like, when you have it, and if you're not sure, then you probably don't have it. That'll be kind of my guidance to entrepreneurs. It's pretty clear when you've got something that customers are asking, not you're sort of pushing it onto them. And that happens in stages and different levels of scale. You think you have it at a sort of one stage, and then you reach a certain level of scale and you realize, okay, to maintain the growth that we've had, we need to introduce something new and iterate. That was kind of our experience. Like, I don't know that we ever got to a point where, oh great, yeah, now we're done. It was just a constant process of kind of reinvention.
Perfect. Well, thanks a lot, Mike. Maybe just to recap, you started TopHat, I guess 12, 13 years ago now. You went through an 11-year journey. Started out when VC in Canada almost didn't exist, the whole industry, right? With really, it's true, the first funds, and rode that out. And meantime, grew the company to what's one of the larger kind of startups here in Canada, raised hundreds of millions of dollars, and now you're on your second startup, and you shared some great insights on making that transition, and just what to expect for repeat founders out there and there's going to be more and more of them here in Canada, which is an amazing thing for the ecosystem. So thanks a lot for that. Appreciate you sharing your story with us.
Great. Thanks for having me.
Thank you so much for listening all the way through. It's been a pleasure having you here. Make sure to subscribe so you don't miss the next episode.